What is a business valuation? A business valuation could be a general method of determining the amount of a full business or company unit. Business valuation is accustomed to verify the truthful worth of a business for a range of reasons, as well as sale worth, establishing partner possession, taxation, and even divorce proceedings. Homeowners can typically intercommunicate skilled business evaluators for an associate objective estimate of the worth of the business. The basics of business valuation. The concept of business valuation mentioned in finance. Business valuation is conducted when an organization is trying to sell all its operations or want to merge with another company or do anything which will be required for the growth of the business. The valuation of a business is the method of determining the present value of a business and study all aspects of the industry. A business valuation is a systematic analysis of the company's management, its capital structure, its future earnings forecast, or the market price of its assets. The tools used for valuation will depend on types of businesses and industries. The most followed approaches to business valuation include a review of monetary statements, discounting income statements, and compare other company data. Valuation is additionally vital for tax news. The Interior Revenue Service, IRS, needs that a business is valued supported its truthful market price. Some tax-related events like sales, purchase, or gifting of shares of an organization are going to be taxed betting on valuation. Methods of valuation. 1. Market capitalization. Market capitalization is the simplest technique of business valuation. It's calculated by multiplying the company's share value by its total variety of shares outstanding. As an example, as of Gregorian calendar month 3, 2018, Microsoft Incorporated listed at $86.35.1 with a complete variety of shares outstanding of $7.715 billion. The corporate may then be valued at $86.35 by $7.715 billion equals $666.19 billion. 2. Times revenue technique. Under the day's revenue business valuation technique, a stream of revenues generated over a precise amount of your time is applied to a multiplier factor that depends on the business and economic atmosphere. As an example, a school company could also be valued at 3x revenue, whereas a service bureau could also be valued at 0.5x revenue. 3. Earnings multiplier factor. Instead of the day's revenue technique, the earnings multiplier factor could also be accustomed to additional correct image of the $64,000 worth of an organization, since a company's profits square measure an additional reliable indicator of its money success than sales revenue is. The earnings multiplier factor adjusts future profits against income that might be endowed at the present rate over an equivalent amount of your time. In alternative words, it adjusts the present P ratio to account for current interest rates. 4. Discounted income (DCF) technique. The DCF technique of business valuation is comparable to the earnings multiplier factor. This technique relies on projections of future money flows, that square measure adjusted to urge the present market price of the corporate. The most distinction between the discounted income technique and also the profit multiplier factor technique is that it takes inflation into thought to calculate this worth. 5. Book value. This is the worth of shareholders' equity of a business as shown on the record statement. The value springs by subtracting the overall liabilities of an organization from its total assets. 6. Liquidation worth. Liquidation worth is the internet money that a business can receive if its assets were liquidated and liabilities were paid off nowadays. This is by no suggests that associate thoroughgoing list of the business valuation strategies in use nowadays. Alternative strategies embrace replacement worth, breakup worth, asset-based valuation and still more.